Let's now focus on L&T Finance, and we thought we'll get a sense on the rural outlook and the kind of sector growth that the company is poised to deliver. Also, the impact of rising interest rates for NBFCs. So let's welcome on board Dinanath Dubhashi from L&T Finance Holdings. Mr. Dubhashi, morning. You do have a high presence in rural segment and the sector itself. At the ground level now, are you seeing the cash flows in your rural customer shaping up well?
Oh, most definitely. So first of all, good news from the monsoon gods. Then yes, the sowing patterns have been good. Kharif crop has been good. Rabi is is also quite good. No doubt that the mandi prices are little below the support prices, but the state governments, various state governments have taken very quick corrective actions, timely loan waivers, also improvement in rural infra, higher spending in MG Narega, good rural roads. It's all leading to not only cash flows but very good positive sentiments in the rural market, which is expected, which is seen in growth in various products like tractors, two-wheelers, etc. Most importantly, proof of the pudding is in eating it. If you see the trends that our portfolio has been showing till December, of course, I can't talk about this quarter because our results are just in 15 days. But if you see overall trend, both in sales as well as collections, not only NPA collections, but even early bucket collections, it definitely indicates that cash flows in rural area are definitely quite good, improving, and most importantly, the sentiments in rural area are very good.
When you say the rural business is improving, can you quantify for us that exactly a year ago, what was the status and what is the status this year? The recovery has been visible for last couple of years now, but can you quantify it for us? And can you give me some example as to where in rural you are witnessing recovery?
So growth, for example, tractor growth, right? 2 years back, tractor industry was in single digit growth. This year, very conservatively, tractor industry has grown by about 18%. FY19 is expected to be another good year for the tractor industry. Two-wheeler industry, especially motorcycles, which are used in rural areas, the two-wheeler industry has grown by 15%, which was very close to zero 2 years back. Collection trends, and I can't talk precise numbers on that, obviously, given that our results are due. But even if you see till December, our rural NPAs have continuously trended down. We expect that same trend to continue not only in March, but in future. And that's, and not only NPAs, but early bucket collections, as I said, are improving. It is not only a factor of improving conditions in the rural market. It is also a factor of the way lending is done in the rural market. Now, actually, if you see the trend and the very way that good lending can be done in the rural market is changing, the data availability in rural India is changing. And from very rough and ready models like monsoon is good, so you lend more, or monsoon is bad, then you lend less, it is changing to very data-based, algorithm-based lending, which overall is will certainly improve growth as well as portfolio trends in rural India.
Right. Share with us about how the MFI book is looking. The two-wheeler and tractor finance did increase in Q3. Are the growth drivers intact in these segments, given the strong correlation to the rural economy?
Oh, most certainly. I think growth drivers in rural India are quite simple. If the farmer is in good health, if the farmer is reasonably out of his debt cycle or debt trap, if the crop is good and the realization of the crop is good, rural India will be good. These are simple folks. They don't understand finance. Their willingness to repay is always there. It is only a question of ability. So normally credit is a matter of willingness and ability. In rural India, it is only ability, because these are simple folks, willingness is always there. So very clearly, the growth factors are completely intact. We expect both tractor and two-wheeler industry to continue to do well. As far as micro loans is concerned, it is not so much a question of demand. The demand is always there. Unfortunately, even today the financial inclusion is limited, and hence the demand is always there. It is a matter of how lenders change from lending more and more to the same customer to going deeper, spreading more, finding new customers who are not over borrowed, and lend there. And if you lend there, your credit quality will always remain good. Hence, the importance of data analytics, importance of digital cannot be ignored. We have to move away from the traditional methods of just forming a group and lending to them. Today, thanks to the India Stack, data is available based on which good KYC can be done, good borrower identification can be done. There are a lot of credit bureau data available, compulsorily available now based on a very good regulation brought out by the Reserve Bank. And using this, any lender can see what is the borrowing level of a customer and find newer and newer customers, achieve definitely proper and real financial inclusion, and also keep your portfolio safe. So it's really as your portfolio will be as good as you are, and the care that you take in expansion. But the scope of expansion is surely there.
Mr. Dubhashi, before we wrap up, analysts have been highlighting higher borrowing costs for NBFCs, and we are seeking banks hiking interest rates. Do you see higher cost of funds as a cause of concern for margins?
Okay, so let me talk about the positives first in the economy. Most definitely, the central government borrowings have come out lesser than what was expected. There are benign prints on inflation. We definitely believe that this has led to certain softening of interest rates. They are definitely below what they were in October, November. Having said that, if you look at FY19 as a whole, interest rates are expected to be definitely higher than FY18. There is no question about that. Now, what will be the effect on NBFCs? I believe, and as I have said at various places, this will separate the men from the boys. Good quality NBFCs, the AAA ones, the AA plus ones, NBFCs which manage their ALMs well, and most importantly NBFCs with good positions in their lending markets, and hence with higher ability to pass on the interest hikes. Last but not the least, NBFC with good fee percentage, which is not dependent on the interest rate cycles, will do better than the others. So it's good, in good times everybody does well. When the interest rates go up, it separates the men from the boys. So we are quite okay with that.
I want to talk about what the share of retail business has been, Mr. Dubhashi, and I understand it's grown from 26% to all the way to 30% now. What is the management strategy here in terms of retail growth, and which segments are you targeting given the high level of competition as well in the same space?
See, our increasing share of retail is not sort of going away from wholesale or anything like that. Very simply, 2 years back when we started our turnaround plan, wholesale was 62% of the balance sheet, and that was excessive for any business, and hence naturally that had to be reduced, and the share of rural and housing both had to be increased, and we have been continuously increasing. Wholesale share today is 56%, and we from 62 a year back, and we expect this trend to continue as we go towards the next and the next year. The concentration clearly will be on rural and on retail housing as we grow our these retail portfolios. Not only that, the trends in these sectors are favoring this, but more importantly, our investment in our strengths, in our in digital and data analytics, in our branch network, in our relationships with manufacturers, and most importantly in improving customer service and turnaround time, is helping us continuously gain market share in each of these segments, becoming more and more dominant in each of these segments, and we expect this trend to continue. So it has been famously called retailization of our balance sheet. Yeah, maybe it is that. More importantly, it is getting all three segments, that is wholesale, housing and rural, in more balance in overall in the balance sheet. That's really what we are trying to do. What it is leading to, obviously, is we doing wholesale business but selling it down, earning fees from that, and capital more going to rural and housing. And that's why you see the trend of retail increasing, and that would continue.
All right, sir, appreciate your time and glad you could join us.